Hi, this is James Eng of Old Capital, and this segment or this month's webinar is called "Breaking the Bank," and we're going to be talking about historically what we've seen cause some of these bank failures, and then we're going to look at the current crisis and sort of its impact not only on interest rates, on the market, talk about what we're seeing out there in terms of opportunities in multifamily investing, and then how people are putting these deals together. So let's just jump into it right now. All right. So, in the last crisis, really, there was adjustable rate mortgages, prices dropped, and then those mortgages started to default, right? And so that really, a lot of those mortgages have been packaged together, and they created large losses for banks. And those losses really froze up the liquidity and the credit markets, and then a lot of banks failed. And so I put up the federal funds rate here on the bottom because you can see that the Fed was raising the rates all throughout 2005, 2006, 2007, and then they paused, right? And so compare that to now, right? So we've risen the federal funds rate up here, but we have not seen this pause yet. And so we'll get into that a little bit later. But I think looking at sort of the historical graphs compared to where we are today is key. So, all right. So here is a snapshot of everything that happened from 2007 to 2012, 13. And, I was in the business, but I was pretty new in the business. And so I don't think I realized all this stuff was happening around me when I was working at GE. But, whether it was Bear Stearns failing and being acquired by JP Morgan, whether it's Fannie and Freddie going under conservatorship, Lehman Brothers filing bankruptcy, Washington Mutual failing, the government throwing 700 billion at the economy, Bank of America acquiring Merrill Lynch, like all these things happening in terms of the largest banks out there that we sort of worked through in 2008, 2009, 2010. And to put this in perspective, in 2008, 25 banks failed, 2009, 140, 2010, 157. So in terms of size, though, really was 2008 was the biggest. And then, compare it to today, with SVB and some of these other banks failing, we have a big number up here already. But, there might be more to come. So this is just sort of a snapshot of how far or how many banks failed in the last down cycle. All right, so here's the Fed balance sheet on the left-hand side. So they really threw, let's call it close to $1 trillion at the sort of 2008, 2009 financial crisis. All these different, I don't know if everyone remembers all of these different rescue plans and things like that, and all the different things they tried to do. But during COVID, they threw out a lot of money, probably 4 to 7, went from 4 trillion to 7 trillion. And then the last couple of years, they've still been trying to sort of slow down the balance sheet. But we see this little pop back up, which we'll talk about in a little bit, of what the Fed's trying to do now for these crises. So, the last crisis was a little different than the current crisis in March. And so I wanted to first sort of set the table on, okay, so why does this happen? So whether it's, economic growth or price growth slows, right? So in the last recession, the price of homes slowed down. Financial institutions really had to sell a lot of these assets at fire sale prices. That causes more prices to come down. And then that sort of gets into the spiral of banks lending less money and people spending less money. And that actually hurts all the assets again. And so we're going to talk about today's current crisis and why that's happening, but sort of keep this in mind that it's hard to break this cycle. And the Fed is going to talk, the president's going to talk and try to break this cycle because it just is sort of a self-reinforcing cycle. So we have to discuss, a lot of times people don't really understand how bonds work. Most people don't invest in bonds. Most people are in stock market. Most people are in real estate. So let's explain bonds for a second. And let's start on the left-hand side, right? So if interest rates go up, then bond prices come down. And so here's an example on the right-hand side. It says, all right, you bought a bond, you paid $1,000 for it. And for the next 10 years, you're going to get paid 3%. Okay, got that. A year later, though, the interest rates go up to 4%. And when it goes up to 4%, your bond is not worth as much, right? So it's only worth 925. And the reason being is you're only paying me 3%. So why am I going to pay $1,000? So that's a pretty simplistic example. You lost 7-8% of your money if you sold it 1 year later, right? And so I was reading a bunch of articles on this, but it was basically like the cash flows can't change, but the price can when you buy a bond. And so when you look in the bottom right and you're thinking, okay, if I bought a bond during this whole section, 2020, 21, beginning of 22, if I bought a bond during that time and 10-year treasury was super low, and now 10-year treasury ran up a bunch, now am I in trouble? And so that's what we're going to get into in terms of a lot of these banks out there. They bought a lot of these bonds. And so, I always, you always learn a lot when your own money's on the line. And so I went on Fidelity and said, all right, let's see if I want to buy a 5-year treasury right now. If I want to tie up my money for 5 years, all right, 5-year treasury today is about 365. So this coupon was 4%. So you have to pay a little bit more, right? Instead of $100, you pay 101 today. But this coupon's 2.75. Instead of 100, you get it at a discount. So you pay less on your principal, but essentially all of these are going to yield essentially the same thing, 3.6, 3.7 in that range, right? So depending on the coupon on the bond, that's going to determine the price, right? So I thought that was a good example of real world if you go out and buy these bonds right now. All right, so let's get into what we've seen the last 2 or 3 weeks. First off, Silvergate. So Silvergate was a bank that had close to about 12 billion in deposits. And then in the fourth quarter, it dropped to 4 billion. So they had a run on deposits. And this caused them to sell some of the treasuries that they had. And they ended up selling 1.7 in securities and had a loss of $134 million. So about 7 or 8% as well. So similar to this example, right? So they had paid $1,000 for the security, and now it had dropped in value by 7-8%. So they had lost money, and basically Silvergate was the first bank to go down. Now, when you move into SVB, this was very similar. So they had a portfolio of about 21 billion, and they sold it at a $1.8 billion loss to cover the deposits that they were losing. So once people heard about this, another 42 billion in deposits left the bank, and this was, I think, the second or third largest bank to fail. So here you can actually go into, and I thought this was pretty interesting, go into the available for sale and the hold to maturity buckets. So these are what people track in terms of what these banks are investing in. So you can see that here in they had about 26 billion in available for sale and had a $2.5 billion loss. And then here they had a 91 billion in hold to maturity and a $15 billion loss. So this was in their Q4 2022 filing. So people knew about this, but nobody thought that they would have to actually sell these bonds. And so not until you did, then you had to sell them, right? And take that loss. And then let's go to Signature Bank. So this was the third bank, and they had a lot of crypto. They had a lot of deposits. And after the run, so this was another thing, the uninsured deposits, right? So FDIC covers up to 250,000. SVP had 88% of its deposits were uninsured. 90% of signature banks were uninsured. And so once the deposits started running, they had to shut this bank down as well. And I don't think Signature Bank really had a huge portfolio of available for sale or hold to maturity bonds, but they did have a large real estate portfolio. So they had about 60 billion in loans. And so those will have to be sold also below market value because of the same issue, right? So they gave out a lot of fixed rate loans, maybe at 3%, 4%, what have you. And then now let's say the market rate is 5 or 6%, right? So it's going to be below market and they're not going to be able to sell them for the par value. It's going to be at a discount. And this is probably the last one that I'll cover. So the other three were in the US. This was over in Europe. And, UBS basically came in and bought Credit Suisse. Credit Suisse was having all types of trouble before. And, I think they asked for a lifeline. Nobody was there to provide it. And so I think the government came in and said, UBS, you're going to buy these guys. Look at the stock price. I mean, just from sort of the last financial crisis at $50, now it's 87 cents. So, I think people are looking at banks across not only the US, but then also the world in terms of potential issues out there. And so what are some of the lessons learned? I think one of them was around the uninsured deposits. So anything above 250,000, if you have very large accounts with that are uninsured, those people could make a run for it. And then also institutions that were, they put a large amount of money in sort of these longer term investments that were at low interest rates, and now they are higher. So here are some of the larger ones, right? So SVB was number one in terms of hold to maturity securities. Bank of America is number two, but I don't think Bank of America is going anywhere. And then here's your list of other ones out there. Wells Fargo's on here, Citigroup's on here, but I would probably look at maybe some of these smaller guys and see, all right, how much in losses do they have in comparison to the amount of equity that they have? So, whenever I like this quote that JP Morgan economist was saying, whenever the Fed hits the brakes, right? So raises interest rates, someone goes through the windshield. And so, obviously we've had 3 of them go through the windshield already. But Moody's downgraded these banks: First Republic, Zions, Western Alliance, Comerica, UMB Financial. So people are looking at the number of uninsured deposits, and then people are also looking at their hold to maturity book. And so if here's a look at uninsured deposits, and then their hold to maturity securities, right? So if you look at Signature Bank and SVB, the amount of uninsured deposits was very high, right? So 93%, 90%, and then First Republic Bank is actually getting very high at 67%. So a lot of these guys have really been beaten down in terms of their stock price. So I think they're trying to prop up First Republic Bank right now. So this was, I was going to start with this chart, but it's probably the scariest chart. And it shows the total amount of held to maturity securities and available for sale securities. And it shows, at the end of 2022, there's about 620 billion in unrealized losses. So that's similar to this chart of who's holding that stuff. And so that is a lot of the equity in the banking system. And so what are people going to do, right? The Fed basically said, look, we can't have any more banks go under. And so we are going to allow you to borrow against 2 programs. One is the discount window, and the other one is the bank term funding program. And they are essentially going to, like if we go back to this example on the on this loan, or sorry, this bond, and it is only worth 925 right now. What the Fed is saying is that you can put up this as collateral, and we will give you $1,000 versus you selling at 925. And the banks have essentially said, thank you very much. We will take all that money. So the discount window was open, and in March, middle of March, that number jumped up from I think it was 150 billion from basically zero. And so the one thing that's unique about this, and that I did not know, is that they will not tell you who is borrowing from the window or from this term program until 2025. Because what they don't want you to do is say, all right, who's borrowing from this window? And you go and take your deposits out of that bank, right? So the Fed is essentially backstopping all of these hold to maturity and available for sale securities that are underwater right now. And so, this little incremental increase right here by a couple hundred billion right here on this little chart in the bottom. The Fed was trying to wind down its balance sheet, and now it is increasing it again to prop up some of these banks. And so this comes from TREP. So we see the deposits coming out of the banks, right? This is in billions, and their borrowings increasing. And you're saying, where's that money coming from? It's coming from the Fed. And so if you go to this slide, and so start on this side, right? So on the left-hand side, their deposits decreased by 100 billion, but then they borrowed 480 billion. And where'd that money go, right? Did it go into securities? Did it go into loans? No, it went into cash. And so the banks are storing cash that they're getting from the Fed right now in anticipation. And so that was a lot to go through of what's happened in the last couple of weeks. The next shoe to drop and where people are concerned is sort of where Signature Bank loans were, is that, okay, so the 60 billion in Signature Bank loans, is that worth any money, or how much is that worth today? And the banks loan a ton against commercial real estate. And so right now, TREP put out, there's about 270 billion in maturities coming up for 2023. And a big chunk of that is office and retail. And, multifamily definitely is a chunk in there, but there's a lot of maturities coming up in 2023. And now, how are the banks going to handle that, right? So if your deposits are going down, if your bonds are losing money, and now you've got losses on commercial real estate, how is that going to impact you as a bank? Depositors are pulling out in terms of, all right, well, you're giving me no interest on my money. I'm going to just go buy treasuries. And then also, how's that going to impact if the banks start losing money on loans, their willingness to lend, right? So second half of 23, we'll have to see what happens here in terms of the actual lending appetite for these banks out there. So, all right, so that's sort of what is going on the banking side, and I wanted to cover that just because you've got to understand sort of the macroeconomic environment because it's what everybody reads day in and day out. They might not necessarily understand it, but then the sentiment of the investor out there is getting impacted by the news day in and day out. And so I wanted you guys to have a sort of a foundation. So here is what the federal funds forecast for SOFR look like. So it's still going up, sort of capping out at 5.5, and then maybe coming down, 2 or 3 years from now. And that all changed, right? So when SVB went down, Signature Bank, all those guys went down. The Fed has a couple of mandates. One is a low unemployment rate, and then trying to keep prices level in terms of inflation. But then I like this little picture. It says the third mandate is financial stability. So if they are breaking the system, then they need to put the brakes on a little bit and cool down this thing. And so here you can see that now it's really baked in. This is at the end of March. Now it's baked in that, all right, we're going to maybe do one more hike on this thing, and then we're going to hit the brakes and pause, and then try to help this economy cool a little bit. So, people have basically bunched a couple of rate cuts into the forecast. So by the end of 2024, they have us down at about 4%. At the end of 25, you're probably closer to 3%, but they typically cut a lot faster than that. So for everybody out there who is on a floating rate, this is good news in terms of your actual interest rate that you're going to be paying. Most people have caps at 2 or 3%. So their all-in interest rate will not change. The people with no caps, this is very good in terms of your actual debt service out there. But the thing that we are not seeing is interest rate cap costs necessarily going down. So until we see this pause, we need that sort of month over month, no movement on the federal funds for those cap costs to come down. So right now they're just are sort of sitting there. If anything, the uncertainty is higher, the volatility is higher, so the cost is just as high. All right, so where's 10-year Treasury going right now? It sort of has been bouncing around. Obviously, it plummeted sort of with SVB and Signature Bank, and it looked like it just was going to keep going, but around 3.4 is where 10-year Treasury sort of bottomed out. And these are sort of the levels that most traders think it should be range bound by, about 3.5% and 4%. So we're seeing a lot of people still be able to refinance at this 3.5 level into whether it's fixed or just or shorter term fixed rate loans, which we'll talk about. In terms of what we're seeing out there in the market today, with all this craziness on the banking side, I would say is people like loan assumptions as long as they can raise the equity. Loan assumptions, you already know your loan amount, you already know your interest rate, so that's sort of set. You don't have to worry about that volatility. So we're still seeing stuff come to market on the assumable side, whether it's Freddie Mac or Fannie Mae. And then the deals that are coming out on new debt, almost everybody is talking about, all right, this is agency qualified, right? So this deal in Dallas, 70% agency, 75% LTV. This one, agency, 70% leverage. So that seems to be the new clearing price is, all right, if I can get a $7 million loan, then I'll pay $10 million for the deal. So around that 70% number. Majority of the deals we've seen out right now are probably in that B and C class stuff right now. We're not seeing a ton of A stuff come to market. A lot of this stuff has been owned, I would say, for 3 or 4 years, maybe 5 years. A lot of stuff out there has not been bought in the last year or two, 21, 22, just because I don't think there's enough equity in those deals at this point where cap rates have gone. So, all right, so we're going to hit a couple of the market updates that Yardi came out with, and really, it's really around rent growth. And, for DFW was the top market in terms of deliveries. But, as a percentage of inventory, I think this is important to look at. It's just under 3%. They're seeing rents basically flatten out for the last 3 or 4 months. But the population of DFW still continues to grow and more people keep moving here. So in Houston, they're seeing very similar in terms of amount of new supply. It's still around that 2 to 3%. And they're seeing, I think rents here about 1,300 compared to the national average of 1,700. Let's see for Dallas. I don't know. We didn't pull in the rents, but it's a little bit higher. All right. So Dallas was about 1,500 compared to 1,700. So, and then Austin probably has the biggest percentage supply. So it's probably closer to like 5% of the supply happening in Austin, but the population still continues to grow significantly in Austin. So across the major metros, they're seeing strong supply additions across the board. Rent growth essentially flattening out to probably in that 2 to 3% range across the board. So let's see. So most of you know my background, but I'll give it to you real quick. Born and raised in Houston, went to school at UT, been up here in DFW since 2006. Started as a loan underwriter at GE Capital, and then the last 7-8 years since 2015 have been focused in on multifamily originating, close to 170 loans over 20,000 units or so, and then invested in numerous, probably close to 40 properties now on the multifamily side throughout Texas as an investor. So, I still keep harping on this. If you are an owner out there, is you've got to figure out how to position yourself to win in all three scenarios. I think majority of people see sort of light at the end of the tunnel. They do see a pause coming. They do see a cut coming, but there might be a challenge. So your interest rates might be getting better, but your NOI might be challenged here in the next 6 to 12 months. So if there is a way to sort of reset your loan term in terms of maturity, in terms of interest rate, this might be a time to do that in terms of a refi. Here is a spreadsheet that we put together with Pensford. This person had a floating rate loan, and they essentially, had a strike at 2.6. So their all-in rate was about 5%. But here, they were able to do a refi above the loan amount that they currently had and sort of fix that rate and do a 5-year, 3 years yield maintenance. And they were able to walk away with close to $900,000 at closing, and then also a cheaper sort of net interest expense for the first year. So setting yourself up to do this type of refi will give you a lot more flexibility in terms of not having to worry about your monthly cash flow on going negative for some reason, or having to buy an interest rate cap out there. So here's a chart that I've been using. A lot of times, based on everything we've gone through, people are like, all right, so why are we still multifamily? Why are we buying anything right now? And I think the past couple months has been, all right, well, single family pricing has gone through the roof just with the interest rates, with the pricing. People are still moving to these major metros. If you look in the bottom right, whether it's Dallas, Austin, Houston, the Southeast, Florida, all those markets. But now I highlighted it in green. The number one reason to be a multifamily is there is still lending available through Fannie and Freddie. So when we talked about all these banks having issues, that is going to tighten up lending. It's going to tighten up lending for all the other property types because there really isn't a way for people to get lending except through banks, except through CMBS for the other property types. So multifamily is still going to be a liquid market out there. And so if you look at the first quarter, Fannie Mae put out their report. I would say Freddie Mac is probably pretty similar in terms of volume right now. But in 2023, they've done through February year to date, they've done about $6 billion, and they have $75 billion. So if they keep up at this pace, times this by 6, they're at 30 billion, 35 billion, and they need to be at 75 billion. So they have plenty of liquidity on the Fannie Freddie side to get deals done. So that is where people are going right now. If you look at I just pulled, all right, what are, DFW, what are people using in terms of new loans? Like this is just a quick pivot that I did, about 75% has been Fannie, Freddie, HUD. And then, 12% non-recourse bridge, and then about 12% recourse bank loans. So, I think this is the number one reason people are still in multifamily, still able to get good loans, at 5.5%, 6% rates, and still close on multifamily, whether it's a refi or acquisition. And, in terms of opportunity, I'm just going to list out a couple here. And we have not, so they're definitely going to be motivated sellers on the bridge side with near-term maturities and just higher cap rate costs. We're seeing them come out slowly. There has not been a flood. And so, people are coming out and trying to make decisions on their portfolio, but with the interest rates going down, that's going to lessen some of the pressure, I would say, on the bridge loans to go right now. And then, this is so recent, but the amount of loans that these banks have, whether it's Silicon Valley Bank, whether it's Signature Bank, all these guys have large loan portfolios. and they might be selling them at a discount. So that might be an opportunity there if you understand that space and if you have access to that in terms of people going early, if in terms of loans going bad or loans being sold at a discount. And then loan assumptions, we talked about, there's a lot of loan assumptions out there right now at, 4 to 5% interest rates, and your loan amount. And then also a lot of these floating rate loans, these escrows are still expensive. So, here's a $10 million loan, 2-year term, and it's still, still 5% of the loan amount to buy that replacement cap. So it's still expensive out there. And so some people just don't have that money to put up, and you can't raise it, can't go through a capital call to raise that money. All right, so here's the breakout of loans out there available for multifamily. I think the most challenging ones obviously are going to be the bank loans. I mean, we're talking to banks, and they're still at probably around 8% plus or minus 50 basis points. So prime right now is 8%. So on the bank loan side, non-recourse bridge around the same 8%. The thing you're gonna have to figure out though on the non-recourse bridge side is where are they getting their money? And if they're getting their money from a warehouse line from a bank, then that might not be a good place to do. If they have their own money, they've already raised their money, then that's probably better. If they're holding it on their balance sheet, they're not securitizing, that's probably better. So non-recourse bridge side is still there, but I would say the left hand and the right hand side are going to be muted, and majority of people are going to be in this middle Freddie Mac, Fannie Mae section, sort of 5.25 to 6% interest rates out there right now. So like we said, the recourse bank lenders, they're going to be around prime plus or minus, and they will have quicker approval. I would say, I would talk to the bank about their deposit base, what their uninsured deposit base is, and make sure they're strong before signing up a loan with them. But this is typically 1 to 15 million. Fannie Freddie, they have 78 billion this year. Still doing a lot of Fannie Freddie, majority of it being sort of either 10.7 or 7.75. So longer term, but then shorter yield maintenance. And this is the backstop for multifamily in terms of lending out there right now. Here's a loan that we did. Borrower was assuming a fixed rate loan. We closed that. I think the rate was around 4.5. So these deals are still getting done. They still had probably about 7 years left on the loan. On the bridge side, we're seeing 8 to 9%, 65 to 70% loan to cost, spreads at about 4 over SOFR. And you're going to need a higher debt yield to refinance because they're using the current rates to make sure you can refinance out of these bridge loans. Here's a deal, Trinity Park, that we closed in Irving, non-recourse bridge on a fixed rate with 3 years IO. And then, on the floating rate, as soon as a lot of these bridge guys out there are trying to get to agency. And so depending on your hold period, if you can hold the deal for a while, then I'd probably go to a fixed rate. But if you're just going to be holding it for a short period and you just want to get out of the bridge, I would probably just go to a floater on Freddie Mac, if that's something that you're looking at. So here's a deal that basically it was on a floater with Freddie Mac, and then we moved it to a fixed rate to get out of the escrows to sort of reset the rate. And then we did a shorter yield maintenance penalty. And then it's back, sort of positive cash flow or positive monthly cash flow instead of a negative one with the escrows. All right. So, why Old Capital? I think through all these different economic cycles, different loan terms and things like that, we help you through all of them, whether it's Fannie, Freddie, non-recourse bridge. So helping you quote deals, win deals, whether you come out to listen to our podcast, speaker series, we represent you, right? And so we're out there touring deals with people, second set of eyes throughout the entire process. And then once you close a deal with us, we can put you up on the stage, whether it's our podcast, our conference, Facebook groups, things like that. And then we usually have sort of monthly networking meetings, speaker series, things like that as well. So we were ranked top 20 mortgage banking firm in 2023, so that was nice. We did about 1.2 billion in 2022. And then, so upcoming events, in case you are in the Dallas area or you come out to the Dallas area, Wednesday, April 26th, we're going to have a property and asset management panel. And then our big conference, October 4th and 5th, you can register for that. They'll probably have about 500 people there at that event. So that's our 7th annual Old Capital Conference. You can register at the website there. And so in terms of next steps, definitely, if you like this video, definitely like, comment. What are you seeing out there in terms of banking? What are you doing to really set yourself apart or as a GP and make sure your investors' money is safe? If you need help with a term sheet, definitely send me the T12 rent roll OM. If you're looking at a deal, you can definitely send me that. I'll review it, just give you some thoughts on that. But yeah, just to get started, really set up some time with me, complete your personal financial statement, and we can go through that. And then if you are looking at joining a firm or looking at, financial role like working with Old Capital, send me an email with your resume and we can discuss from there. So appreciate you watching. And if you have anything you need from me, please feel free to reach out via email or give me a call. Thanks.